everyone, welcome back to another episode of Market Update featuring by MarketsAll and Rationale. Last week was packed with pivotal macro data. It's already reshaping the expectations for the Fed next move. We had the July of FOMC meeting where the Fed held rates steady, but for the first time since 1993, we saw two dissenting votes, especially with the help of, for sure, political pressure on Fed governors. And just a days later, the July jobs report came in with big downward revisions, weak a private sector hiring, and further cracks showing health beneath the surface of the labor market. In today's video, I'll try to break down both the Fed decision and the non-farm payroll data, what changed, what Jerome Powell signaled in the FOMC meeting, and how markets are responding all this data flow. We'll also talk about why this all but locks in a rate cut for September meeting, and still I think the soft landing scenario is the base scenario, but yeah, for sure something has changed. So let's try to break down with starting with the economic calendar quickly. So first of all, I didn't write here, but the Fed decision, they held rates steady in the latest the last Wednesday, but the governor dissented. And the opening paragraph of the statement included a slight downgrade to growth expectations. However, in the press conference, Jerome Powell did not sound pessimistic, though. He described the outlook as still within expectation, aligning with the soft lending narrative, especially when discussing the personal consumption. One notable change is the previous statement had mentioned that risks to the outlook has diminished. That sentence was removed this time. So especially apparently they see that risks are on the table. In response, there was a question about the trade deals reducing risk and stuff. Jerome Powell replied that broadly unchanged. And the press conference highlights the one of the questions, for example, will the Fed cut in September? And his response was, it depends on data. As usual, markets was pricing around a 50-50, but currently that's it's kind of a locked right now, the September rate cut. Yeah, I was mentioning in previous videos as well, I was more on the team that they were running a bit late on rate cuts, because that economy is being prosperous was providing some room for them, but at least the inflation signs have been weak for a while, apart from just one inflation data as far as I remember, but also soft indicators and stuff. The major focus had shifted to the labor related or growth related data already. On inflation, Jerome Powell said the composition of the inflation is changing. Service inflation is now seen as less of a future risk, which is in line with my thoughts as well, while product prices may feel some pressure from tariffs. Also, I had mentioned in these videos that a good inflation had shown some little, it was little, but there was a little bit strength relative to service side, despite the fact that service side has been the main source of the problem up until right now. So far, tariffs haven't shown up strongly inflation data, partly because retailers have been absorbing costs up until now, and maybe at some point they weren't able to absorb, and that those costs will shift to consumers, and that will lead to some inflation for sure. He also addressed the housing. The problem isn't just a higher mortgage rates, converse to Donald Trump's thoughts. It's also some supply side issues, not too much house coming into the market. and he was clear that the Fed's job isn't done to like a Fed's major job is like controlling the inflation and like sustaining the consistent like a labor market, not helping the government to borrow more cheaply, because I'll address the main problem a little bit later, why all these like fights are coming into like between the government and between Donald Trump and Jerome Powell. So it's all about like this debtness that United States have been like dealing with. So as for the dollar also, that's also a Treasury's job, not the primary concern of Fed for sure. That's he mentioned. So what was the market reactions after the meeting? So the dollar index rose for sure until that. It was a bit like a bit hawkish tone, and gold prices. So like there was a like gold investors were already looking for some profit taking activity. They were looking for a reason to take some profit actually, and there was a good opportunity for them, and we saw a huge sell-off in gold, and equity markets ended like the day flat, to be honest. But because like the first reaction was sell-off, then we saw some reaction thanks to the like earnings growth, still like ongoing earnings growth, especially sourced by like AI infrastructure related companies. And about like a bond yields, that I'll show you in the chart section as well. It rose, but not in a like a dramatic way. And yeah, like that was the general picture about the around the FOMC. Like also like last week was like packed off like a lot of technological companies earnings. Among the Magnificent Seven, the latest earnings were showed on one like a clear theme. AI is like AI side is on its way to make some money for the companies that are investing in it. So as long as we see like capex levels are increasing for the companies, that means that they have some projection on profitability on the AI side. And yeah, that's the general mentality over there. That's why I think that's the compensation. That was the compensation for the FOMC meeting. And yeah, I mean, we can say that it's like there's a really like a growing momentum out there. When we come to the labor market data, like the NFP number, as you can see here, first of all, the headline figure came in 73K. It was slightly below expectation, but when you dig into like a private sector data, private payrolls just rose 83K in July. So, but the highlight of the data was downward revisions that came into the previous months. The 3-month average for private payrolls now sits around like a 52K, and for the total payroll, the 3-month average has dropped to just like a 35K. A few months ago, it was like around like a 150 levels, and like a revision to the past 2 months were also like were around like there was a net reduction of 250K, around 250K jobs. So that was the main highlight of the week. So with that news, with that data flow, we saw that the market reaction we saw some compensation to the reaction that we got from FOMC meeting, because this time the labor market was doing bad. With that mentality, rate cut expectation shifted like sooner, and we saw some dollar weakness and stuff, and I'll show you in the charts as well. When we go to like, as you know, like there are like two different surveys that is like a sourcing the NFP number, like NFP and unemployment number. One is the source of NFP, one is the source of the unemployment number. So household survey, it confirms the weakness. The household survey, like the employment at individual level, it captures that. We saw like a drop like 260K in employed person. I mean that's a problem for sure. and as a result, the unemployment came in 4.2%. But like the broad unemployment ticked up from ticked up to 7.9%. When you go to the average hourly earnings data, which is important in terms of evaluating the inflation situation in general, it seems like it's now like no longer like a realistic source of the inflation pressure. The wage price spiral. The healthcare and like a social assistant contributed like 73k, and government employment actually fell by 10k, and like across like multiple sectors we're seeing some negative prints, something we haven't seen for a long time. So that's why the NFP data was the key data of last week. So what was the market reactions? What was the policy implication? First of all, I think after this data, the September rate cut is now fully priced in. In the short term, we might see some recession talks for sure. This for sure will weigh on equities at first. That's what you expect. But at the same time, we see that earnings side is seems pretty solid. Probably that will compensate it. But the main mentality is, after such data, the important part is it will depend whether the market will perceive this as a red alert for companies' growth, or they will weigh on rate cuts. And in that scenario, if they weigh on rate cuts, we see some appreciation in equities and risky assets. So it will all depend on the perception. That's the general picture in general. Sorry, that's the general mentality right now. After the data, bond markets, we saw a sharp decline, and also a dollar index, there was a huge sell-off. Then I found some support in the main a support area. Also technically, gold, with the rates coming down, the real yield came down. With that, we saw a huge spike in gold as well. And that was the general picture after the non-farm payroll number. And today, while I'm recording the video, we received this week started with a risk on sentiment again, as a earnings growth and the rate cut expectation. So depending on my analysis, according to my analysis, I said that the pricing will depend if the market weigh on rate cuts or a recession. So this week started with the mentality that the market will weigh on rate cuts. So that's why we saw some risk on activity in market prices. Then today we received ISM numbers, and I think just while I'm recording this video, I saw some little a sell-off in equities, S&P 500 futures, because when we receive such data in the ISM side, that signals economic weakness, and economic weakness might be perceived as recession risks. So after this we'll just go between recession risks and rate cuts, and the market pricing will depend on the market perception. That's the biggest challenge, to read how the market will react and stuff. And up until now, this week, I think still the uptrend is ongoing. Still the soft landing scenario is the base scenario for me. So let me just skip to charts as usual. But before getting into charts, I just wanna try to explain you the general market condition right now. Why there's let's say argument between the government side and the Fed. So in the beginning of this year, the Republican government, they started with a Dodge, Department of Government Efficiency department. They tried to decrease the government's costs, right? That was the one thing, because the US debt level has reached the record levels right now. And when you look at a section by section, you see that the biggest concern is interest payments. And considering the current levels of like long like US 10-year yields and like rates yields, that interest rate levels are too much. So it's maybe the interest payments that is done by the government is higher than healthcare spendings, for example, and that's a huge number. So in order to get rid of this situation, their first plan was to go through some like a cost-cutting activity, and they established like Department of Government Efficiency, Elon Musk involved in it. Then it didn't work. So one other option right now, that what they're trying to apply is they're trying to control the short end of the yield curve by pressuring the Fed. They're resisting right now. There are like a lot of different reasons, but one other like perspective of this plan is actually going through cryptocurrencies. How? So maybe you all heard that the stablecoin hype, like maybe just like last 1 or 2 months, there's been huge hype. Especially we saw huge price increase in crypto stocks like Coinbase and stuff. Circle also, like there was an IPO of Circle, and it's pumped a lot. The main idea behind that, all stable coins right now, in general, when you buy a stable coin, they go with that money and buy a US short-term treasury notes. And with that demand to treasury notes, we see that yields come down. So in order to push those yields, in order to decrease the interest rate payments of the government, they are providing some room for stable coins. And by making those stable coins attractive, people will invest them. And with that investment, when you go to the proportion of the stable coins in the like US treasury holders, it's a huge amount. It is at its record levels. So that's why they're just like promoting crypto. With that mentality, in general, I'm still bullish on crypto side as well, because that's the only way right now, it seems like, at least, to control this interest rate payment. So just as a little like a footnote, I just wanted to mention this current ongoing situation. So let me just quickly show you this 10-year yield chart that I'm following. With the when you go to the daily chart, today is this like a red bar is the non-farm payroll day, and with the week data, we saw that like there's a huge sell-off in the yields. Like there was a huge demand as the rate cut expectation increased, and yeah, that's how I'm following. I just wanted to show you this. As long as it's like within this range, I don't see it is like a problematic for risk on asset. When you go to the US 2 years yield chart, same here. There's a rectangle chart pattern that I'm watching, and if we see a breakdown from here, I think there will be much more room for risky assets as well. Quickly, let me skip to cross US 10-year yield and Japanese 10-year yield spread. And when you look for like interest rate differentials between currencies, when you just want to trade, for example, USD Japanese yen, just go first of all check the differential between yields of those two currencies. So here, as you can see, a potential like a fake breakdown. Now it's acting again, and if it moves like this in USD Japanese yen, in this descending triangle chart pattern, there might be a shorting opportunity with a stop loss around here, for example, and being like a short from an active price and targeting a breakdown. Maybe you can just start building your position here, then you can add to your position after a breakdown. That's why I just wanted to show you this. And S&P 500 chart here in the like today, for example, as you can see, it's like a 0.3% down right now with the ISM numbers actually. And as I mentioned again, I'm following it with the mentality of it's just like a ball, like tennis ball between recession risks and rate cuts expectation. But in the short term, technically, how I evaluate this, let me show you. I was following this like up with handle breakout, pulled back, and it resumed this price action, and there's a retracement here. Let's see where we saw a rejection. As you can see, this is 21-day moving average, and 50-day moving average still holds it. Yeah, that's how I'm following. Still, like the long-term uptrend is still intact. And gold with the rate cuts expectation, we had rate hikes expectation, real yields. We saw that we saw this movement because real yields were increasing. Then there was a sell-off, profit-taking activity in gold. But now, after NFP, seeing a negative data in ISM number put some weight on recession risk side a lot more, because when there's a recession probability, we saw some appreciation in gold price. And technically, I'm following this consolidation here. You can call it ascending triangle, or I don't know, just you can get this part and call it as like a rectangle-ish, rectangle chart pattern is being formed, but a potential breakout would push gold prices towards 4K levels. And Bitcoin, I'm following this in the weekly chart, it's more apparent. This, you can call it, I don't know, head and shoulder continuation chart, or I don't know, cup with handle, it doesn't matter. But when you zoom in, especially in the daily chart, I would like to show you, just check where we saw a reaction. I think 112K level is the most important level that we need to watch. If we see it to come below this level, then maybe we might be alerted a bit. But that's how I'm watching Bitcoin price right now. And Solana here in the weekly chart, there is like a head and shoulder topish chart pattern is like a not like a fully formed, but if you take it like that, this kind of chart pattern might act in both directions. If we see a breakout, then it will be head and shoulder failure chart pattern, and if we see some price movement like this, it will be called as head and shoulder top chart pattern. So I'm waiting. If I see a breakout from here, then this level might be a good level to open a long position. But if we see a breakdown just up until around these levels, it might be a good area to short it. Ripple chart. In the Ripple chart, in the daily chart, I had shown this head and shoulder bottom, it reached its price target almost. Then it moved back, and we saw some reaction from the short-term moving averages, as you can see here. But when you go to the weekly chart, here is also, there's a potentially upward handle chart pattern might form here if we see some consolidation and move like this. So any potential consolidation around here and a breakout from this consolidation, it might provide you the first entry around like a here with a stop like this. Then you can add if it manages to go higher. And lastly, I would like to show you this Ethereum chart, the weekly chart. Following this head and shoulder continuation chart pattern again. And yeah, if it's reached around like I don't know, 4,100 levels, then I'll be watching it closely as a trade opportunity. So yeah, overall, that's all I'm going to talk about this week. Thanks for your time. Thanks for listening. I wish whatever you find here is helpful for you. And if you find it helpful, your support is pretty important for us. So you can subscribe to MarketsAll YouTube channel. That will be great. And if you just can share all like these videos to your friends that are interested in. And I wish you a really nice week. Have a good one. Bye.